Hi guys, my name is Ivan and this is my first YouTube video. I wanted to start a series of YouTube videos regarding trading and investing. So my idea is to show you my view on the market, and I'll try to connect the dots and show you that you cannot just look on the one instrument isolated from all other asset classes, as everything in the world is interconnected. So the bond markets, the equity markets, the derivative markets, commodity markets, and the FX markets, of course. So it's always a question: what comes first, chicken or the egg? What moves what? Does the bond market or the interest rates are influencing on the FX rates, or does maybe equity market is influencing on the commodity market? That's a question that I cannot ask you, that I cannot answer you at the moment. But what's sure is that you have to check out the whole picture, try to connect the dots, and then see what you will trade, how you're going to position yourself in the market, and how to make money. You need to see where the money goes to, basically. Over analyzing is not good also. It's called analysis paralysis, and I will show you that you can be your own fund manager. Compare your interest rate that you can get on your savings. Let's say in the bank, it's up to 1, 2, maybe 3%, depends on the currency. Maybe even less if we talk about the euro. So if you compare that, how you can earn on your savings, with the fact that with a little bit of knowledge and a little bit of skill and a lot of patience, you can make easily 10% a year by trading or investing. Depends on your time horizon or how you view on it. So what if I tell you that you can easily make 10% a year with trading without much effort, and most important, without much risk? It sounds great, but nevertheless 95% of the traders or the people who are involved in financial markets are losing money, because 10% is not enough for them. So they are all looking at the highest figures. They want quick rich scheme. They want crazy returns like 10% a week or maybe more. I'm not saying it's not possible, because everything is possible. Everything in the markets is possible. But on the long run, and for the majority of people, it is unfortunately unsustainable, and that's where they get into trap and where they lose. I will show you how to strip down the charts and how to use a larger time frame in your favor. So the larger time frame talk a lot, and all you need is to analyze where the big movements in the markets are. Be patient, catch it, and then again be patient and hold it, right? It's simple, but not easy. Certainly not easy. On the first slide, I'm going to show you the bond markets, just to give you a quick overview of how are things running around in a real financial world. So this is screen out of Bloomberg, and we'll start with the bonds. So bonds which are maturing in 2 years. So if you want to invest in bonds with maturity of 2 years, you can see across the world how much can you earn on these bonds. So in the United States, on the dollar, you can earn 0.14%. So this yield to maturity is your earnings. Canada, you can earn 0.26. If we are going to talk about Europe, so you see the whole European Union biggest countries are negative in their yields on their 2-year yield bonds. Sorry, English might not my first language, so when my tongue traps, don't be harsh on me. So United Kingdom, this is where we go talking about sterling, but okay. So this is basically flat 0.09 negative. France and all others beside Switzerland are the euro interest rates on the euro currency. So if you want to invest in France government bonds, you are not going to earn anything, and you even have to pay 0.63% in order to buy a France government bond. What's that telling you? What is the basically it's telling you that the investors across the globe are more certain than have more, let's say, have more confidence in French government bonds than in euro currency itself, that they are ready to pay and hold until maturity the France government bond. Germany also the same, slightly more negative. So Italy is around 0, Spain, Portugal, Sweden is also not euro, okay. Netherlands also like Germany. So basically with this low interest rate environment and negative rates that ECB is introducing, you are getting the situation which never happened in history, that the yield on the bonds are negative. This is the 2-year maturity bonds. Now we'll go up to 5-year maturity bonds. Here we can see United States 0.27 comparing to 0.14, not much of a difference. If you look then again at Europe, you can see Germany is again like minus 0.65 comparing to 2-year minus 0.67. So it's whether you invest in 2-year bond or 5-year bond, the your return is the same negative rate. What's that telling you? That investors are not even looking for the premium for liquidity, let's say liquidity premium, which means they will get their money earlier, meaning if they want to get their money earlier, they will expect a lower interest rate, and if they are willing to invest their money on longer term, they expect to earn more. Why? Because their liquidity is, let's say, trapped into these securities, even though these securities are highly liquid, but nevertheless they are not cash. So you can see again negative rates, almost the same as the 2-year as the 2-year bond in the whole Europe, Japan also. Then let's go to 10-year. America, for buying American government bond with 10-year maturity, so they will get your money back in 10 years, or you can sell it on the market, of course, but let's say you're holding it till maturity. So this is where you earn 0.5% a year. This all percentages are on a yearly basis. So we're comparing now 0.14 2 years, 0.27 5 years, 0.58 10 years. And now I'm telling you, you can make 10% a year, and for the majority it will not be enough. Okay, let's say 10-year Europe. So again we see a negative rate for the France, Germany. United Kingdom is slightly positive, and it's not really much. 0.14 on a 10-year bond. Italy is around 1%, so 0.99. Spain 0.3, 0.3 Portugal, and even Greece is improving. So Greece, who was on the edge of bankruptcy, now if you want to buy their government bonds on 10-year maturity, you can earn only 1%. Not very promising. I will leave down these tables and you can check it afterwards. If you have any comments or any questions, just write them and I'll try to answer them, or make another video about something that is maybe not clear enough. And I will not in this first video I will not go too much into details, but I just want to break the ice. So make the first one and then we'll see afterwards. If you're interested, I'll make more videos. Everything will be free, everything will be available, and I'll try to make let's say a little community of the people who are interested in trading and investing in the markets by themselves. So teach them how can they do it, and set realistic goals for them. So this is something also from history. This is a yield, so in let's say an interest rate on 10-year German government bond. Why always German? Because pricing other bonds on the market, the banks are always using German government bond as a benchmark, because she's like a symbol of safety, stability. If somebody is going to pay you back, if somebody is not going to going bankrupt, it will be Germany. That's how investors perceive the market and the country. So from 1991 until now, from this chart, which is a quarterly chart, all you can conclude is that the interest rates are in constantly decreasing. So from around 9%, they are constantly falling and falling and falling and falling. On the last crisis, so 2009, they were like 3%, and then they again fell below zero, let's say somewhere around mid of 2019, and now they are much below zero. This is the United States generic government bond yield, also 10-year maturity. There we have more data, and we can see that from 1971 there was an increase, and again from, let's say, the 80s, and if we compare like with the German or European from the 90s, we don't see any up movement, so it's only a down movement with a retrace, another low, retrace, another low with retrace, another low with retrace, and so on and so on, so again until 0.5 here. These slides show you historical spread, so between these two rates, and here you can see that as we are approaching now, that the rates were following each other, let's say, for quite a while, from 1991, and then suddenly 2013 the spread started to widen, and it's pretty large now. So the spread is between the German and United States 10-year bond is much wider than it used to be in history. Okay, here is one slide which is showing you the euro swap rate and the dollar swap rate. So the green one is the euro swap rate and the blue one is the dollar swap rate, and here on the bottom side is there's a spread between, but we'll look just on the first chart. What you can see on the first, when you look at these charts, so that you can see that on the x-axis it's a 10 years, so it's years, and this is interest rate. Let's say that the yield curve on both currencies is acting the same, so there are some positive movements up to 15 years, and then the yield curve is flat. We say flat when it's a straight line, horizontal line. It's almost a horizontal line, and then even after 40 years it's starting to fall a little bit, but nevertheless we can conclude that the yield curve is flat, no matter of maturity. So there is no liquidity premium whether somebody wants to invest in something that is maturing in 10 years or 40 years. The rate is pretty much the same. That's also one of the paradoxes. The usual yield curve, the normal yield curve, is rising. So if you want to invest on the short end, you will get a lower interest rate. If you want to invest in the long end, you will get a higher interest rate. So the yield curve should look like this. So this is the normal yield curve. I can draw it somehow. Let's say, where is the shapes? No, not this one, but this one. So now so this is, let's say, normal yield curve. On the short end, you are earning lower rates, and it is, by the time is increasing, so you wanna earn more and more and more and more and more. So if you want to tie your money on 40 years, you are expecting a much higher rate than investing your money on a 3-month basis. Here I'm going to show you some charts of the major currencies. So here's the euro dollar, all quarterly charts starting in 1975. I will not here give any conclusions. I will just let you see it, how does it behave, how it's going. Just observe, nothing more. The last, let's say, 20 years, maybe a little bit less, we are in some sort of a down channel. Now we are challenging upper part of this down channel, something a little bit below, or maybe a level of 120. It will be interesting to see whether the euro dollar now will push up or will remain in this channel, which means going down. But remember, every single candle here on this chart is 1 quarter, so 3 months. So you're now analyzing a big time frame, and by using this, and if you can really spot that there will be a turn, like you could have been spotted this there, you can really make a lot of profit. But you have to be patient, because this is 3, 6, 9 months being in a single trade that can go in one direction and can also go back. So your profits can be erased. But you need to know what you're looking for. You need to be patient, and you need to be humble. You need to be not greedy, and you have to respect the market. That's my advice. Here we can see the pound dollar. So the pound dollar has also its movements, but generally going down, especially after the Brexit decision. The pound went down heavily. There are currencies that are considered safe haven So when it comes to crisis, you can see that the dollar is pretty much, let's say, currency that is considered a safe haven comparing to euro, also comparing to British pound. And here we have opposite situation. So this is the dollar yen. The dollar yen is also constantly decreasing, and we can see also in times of crisis that the yen is considered to be a safe haven currency. What also we can see here is that the moves or the candles are getting smaller and smaller, and the move on in the last 5 years is really narrow. So the range where the currency moves is really narrow. That could mean one thing, that we can get now a big reaction on the one side or the other, or it can stay, of course, flat. But be sure that if it breaks these levels where it's moving around, hovering around last 5 years, the new reaction will be much more higher or much more lower. Okay, now the dollar CAD. Here we can see everything across the board from the 70s, where the dollar is constantly getting stronger against the Canadian dollar, and then to 2000s, when the Canadian dollar is pushing back down, so Canadian dollar getting stronger against the US dollar, and then afterwards we are again facing an uptrend. So we are here currently on an uptrend, and this is important fact to having in mind when we will be analyzing, let's say, potential investment on a lower time frame scales. Last but not least, the dollar, the Australian dollar, United States dollar, so Aussie, popularly called Aussie, also showing a weakness from the 70s till 2000s, then have some recovery within the next 10 years, and then also showing weakness in the last 10 years. So basically, if I ask you, is this price going up or down, on the first, without much analyzing, without drawing 100 lines, without having 745 indicators on the chart, if I ask you where this price is going, you're going to tell me it's going down. Yes, for now, and it looks like it's going down. So when we are analyzing the lower time frame, if we see an opportunity in it, we will go in the direction of the higher time frame, because in this time frame everything else is included. Everything else is priced in. There is no randomness, there is no chaos like in 5-minute chart. The picture picture is clearer. So if you move away a little bit, you can see better than if you're glued to the screen. So with this I would conclude my first video, and I hope you liked it. In the next video we will have let's say concrete analysis of one instrument and some recommendation. Is it the buy or sell, at what levels, how to position yourself, what to wait, and how to make some money in the end. Stay safe, stay healthy, and catch you later with another video. If you liked it, please leave a comment, or I don't know, click the like button. I'm not going to mention it, or if you want to subscribe, if not, but leave me some feedback that I know that you like this content, and that I can really then make some more effort into giving you more of the content from the financial sector, from the financial industry. I know it's not maybe so entertainment like playing video games, but it is what it is. Who is resonating with me, I will do my best to help. So bye everybody, until the next video.